So consumers right now are taking out 46% more new credit cards than they were just a year ago.
Hmm.
And they're originating like 41% more auto loans. But somehow, and this is the crazy part, despite this massive debt binge, the rate of people actually defaulting on their bank loans is dropping.
Yeah, it's totally counterintuitive.
It really is. Well, welcome to today's deep dive. We are looking at a pretty wild financial paradox today, and it's fueled by a brand new, highly revealing earnings report.
Right. We've got our hands on the Q2 2026 financial results from Wells Fargo, which just dropped today, July 14th, 2026.
Fresh off the press.
Exactly. And for our sources today, we are pulling directly from the official Q2 2026 financial results presentation and the accompanying news release straight from the company.
So no third-party spin.
None at all. There's no media commentary here. We're just looking at the raw data straight from the bank's own reporting.
Which is exactly how we like it. Our
Yeah.
mission for this deep dive is to really decode these corporate financials. We're not just going to, read an audio balance sheet to you.
That would be incredibly boring.
Right, nobody wants that. We are going to explore the mechanics of how one of America's largest banks is actually operating right now. And more importantly, what their internal numbers reveal about the underlying health of the broader U.S. economy.
The economy that you live and work in every single day.
Exactly. Okay, let's unpack this. We have to start with the headline figures because, the sheer scale of the money moving through this institution is unexpectedly massive.
It really is. The top-line numbers show a bank that is operating with, honestly, intense momentum. In just the second quarter of 2026, Wells Fargo's net income hit $6.4 billion.
Wow.
Yeah, that translates to $2 per diluted share.
Okay, let's pause on that $2 per diluted share for a second because diluted share is essentially the most conservative way you can measure a company's profit, right?
Correct. It's the absolute baseline.
It assumes every single outstanding stock option, every convertible bond just gets cashed in for stock.
Exactly. It's the maximum number of slices you could possibly cut the pie into.
Right. So even in that absolute worst case scenario where the pie is sliced into, the maximum number of pieces, they are still generating $2 whole of profit per slice in a single quarter.
Yeah, that's the exact mechanism. It
Yeah.
gives investors the most grounded, conservative view of profitability. And when you zoom out, that $6.4 billion in net income, that's a 25% increase from exactly 1 year ago.
A 25% profit surge. For a legacy bank of this size, that is staggering.
It's massive. And that brings their total revenue for the quarter to $22.6 billion, which is up 9% year over year.
And it's easy to look at a 9% revenue jump and just sort of nod, but we really need to understand the mechanics of where those billions are actually coming from.
Right, you have to look under the hood.
Yeah, look under the hood at the two main engines of bank revenue, which are net interest income and non-interest income.
Right. Those are the two fundamental levers that every major bank pulls. So net interest income, or NII, that's your traditional spread.
The classic banking model.
Exactly. It is the mechanical difference between the interest the bank pays out to you for keeping your money in, say, a checking or savings account, and the higher interest rate they charge when they lend that same money out for a 30-year mortgage.
Or like a small business loan.
Right. For Wells Fargo, that core engine grew by 5% year over year, hitting $12.3 billion.
Okay. And the presentation explicitly notes that this was driven by higher loan balances and lower deposit costs, meaning they are successfully lending out a higher volume of cash while at the same time managing to hold the line or even reduce the interest they have to pay depositors to keep their cash parked at the bank.
Which is the ultimate tightrope walk in banking.
Really is.
But while a 5% increase in that traditional core business is solid, it actually wasn't the primary driver of their overall 9% revenue jump.
Right.
The real heavy lifting came from the second engine, which is non-interest income. This jumped an incredible 13% to $10.3 billion.
Okay, so if a bank is a restaurant, net interest income is the profit they make selling the actual food, right?
I like that, yeah.
It's the basic everyday margin of loans and deposits. But non-interest income, that's the VIP cover charge.
Yeah, it's the valet parking.
Exactly. The valet parking, the private event bookings, the premium services. It's the fees they generate from wealth management, investment banking, trading, all that stuff.
Yeah.
So what specifically fueled that 13% surge in the VIP section?
Well, what's fascinating here is the combination of aggressive strategy and just sheer market momentum. The report highlights strong performance in their venture capital investments, higher investment banking fees, and significantly higher market valuations.
Which boosts their wealth management advisory fees.
Exactly.
Let's break down the mechanics of those market valuations, actually, because that is a massive windfall that often just flies right under the radar.
Oh, absolutely. It's huge.
Like, if Wells Fargo is managing, say, $1 billion in assets for a group of wealthy clients and they charge a standard 1% advisory fee, they collect $10 million.
Right.
But if the broader stock market just naturally goes up 20% over the year, those assets are suddenly worth $1.2 billion.
Yep, the math just scales.
So the bank's 1% fee is now $12 million. They didn't have to win a single new client or do an ounce of extra work, but their revenue from those fees automatically jumps 20%.
That is the beauty and, honestly, the danger of assets under management. You ride the wave of the broader market, and the S&P 500 has had a very strong run leading into mid-2026.
So Wells Fargo's wealth management division is just mechanically capturing a percentage of that macroeconomic growth.
Exactly. But it wasn't just passive market gains. When you look at their corporate and investment banking segment, banking revenue was actually up 20%.
Wow.
Yeah. And the report highlights that their U.S. mergers and acquisitions deal volume rank jumped to number 4. They were ranked number 9 in 2025.
Wait, jumping from number 9 to number 4 in M&A advisory in a single year, that is a massive structural shift.
It's huge. You don't just stumble into that kind of volume.
No, that means they are actively poaching top-tier talent. They're successfully cross-selling investment banking services to their massive roster of commercial lending clients, and they're aggressively taking high-margin market share from their Wall Street rivals.
They are. They're executing on a very specific strategic pivot to rely less on basic lending and way more on high-fee advisory work. And, it's clearly paying off.
Which brings us to a critical transition, because it's relatively easy for a corporation to grow revenue by just spending a fortune.
Right. Anyone can buy growth.
Yeah. Expanding operations, poaching elite investment bankers, upgrading technology, none of that is free. The real test of a bank's health is whether they bought that 9% revenue growth or if they actually engineered it efficiently.
And this leads us directly to a metric that management teams absolutely obsess over, which is positive operating leverage. Wells Fargo achieved this in Q2 by keeping their total non-interest expense at $13.7 billion. That is up only 2% from a year ago.
Wait, so they grew their revenue by 9%, but the cost to run the entire operation only crept up by 2%.
Exactly.
That massive spread between money coming in and money going out, that's what drops straight to the bottom line, driving that 25% surge in profit.
You nailed it.
But think about the mechanics of pulling that off in an inflationary environment. Like, how are they keeping costs almost flat while doing significantly more business?
Well, it requires an almost ruthless internal reallocation of capital. The presentation actually breaks down that 2% expense increase beautifully.
Okay, what does it say?
Their non-revenue-related expenses actually dropped by 1%, but their revenue-related expenses rose by 19%.
Meaning they are starving the back office to feed the rainmakers. They are aggressively throwing money at the things that directly generate income, like massive incentive bonuses for those investment bankers who push them to number 4 in M&A while cutting the budget for literally everything else.
Exactly. They are cutting the fat to afford the muscle.
Yeah.
And the most visible way they are cutting that fat is through headcount. Total headcount was reduced by 7% year over year.
Wow, 7%.
Yeah, they're down to 197,000 employees. And they are also shedding non-core physical assets. For example, the report notes they sold off their rail car leasing business in the first quarter of this year.
Getting rid of a capital-intensive physical business like leasing train cars so they can focus on purely digital, high-margin financial transactions, that makes perfect sense.
Total sense.
But I have to push back a bit on the human element of this strategy, because they banked a 25% profit surge. They are making billions, yet they cut their workforce by 7%.
Yeah, which is thousands of jobs.
Thousands of people losing their jobs. So I have to ask, is doing more with less to this extreme actually a sustainable long-term operational strategy? Or is this just the classic corporate playbook of squeezing the lemon dry, boosting margins for a few quarters to please Wall Street before the underlying service begins to rot?
It's a really fair point, and it raises an important question about the physical limits of efficiency. Management would definitely point to the underlying digitization of the banking industry as proof that this is sustainable.
Right.
If a bank can automate massive portions of its back office compliance and data entry, they simply don't need the same army of analysts they needed, say, 10 years ago. Furthermore, look at their consumer behavior data. Their active mobile customers are up to nearly 34 million.
34 million. So if 34 million people are just depositing checks and applying for loans on their iPhones, the bank inherently needs fewer physical brick-and-mortar branches, right?
Exactly.
And fewer tellers to staff them.
Precisely. The technology is absorbing the work of the thousands of employees they let go. But your pushback is entirely valid. There is a floor to this strategy.
Right. You can't just keep cutting forever.
No, you cannot shrink your headcount by 7% every single year indefinitely. Eventually, you cut past the fat, through the muscle, and into the bone of customer service and operational integrity.
And if the mobile app goes down or wait times for customer support stretch into hours, those 34 million customers will just move their money elsewhere.
Absolutely. For right now, in Q2 of 2026, Wells Fargo has found a very lucrative sweet spot where their efficiency initiatives are dropping straight to the bottom line without breaking the machine.
So the institution itself is much leaner, it's highly digitized, and significantly richer. But all that revenue, those tens of billions of dollars, they don't just materialize out of thin air. They come from everyday consumers pulling out their debit cards, small businesses making payroll, and massive corporations expanding operations.
The real economy.
Exactly. So if we shift our focus from the bank's internal operating efficiency out to the wider world, what do these numbers actually tell us about the real economy out there?
Well, the demand for credit across the economy is running hot. Average loans across the entire company are up 12%, bringing their total loan book to over $1 trillion.
$1 trillion in outstanding loans.
Yeah.
It's kind of hard to even wrap your head around that kind of liquidity.
It really is. And when you look closely at the consumer segment, the velocity of borrowing is striking. Auto loan originations are up 41%. New credit card accounts are up 46%.
Gee.
And it's not just borrowing on the consumer side. Wealth accumulation is also surging. Client assets in the Wealth and Investment Management division grew 15% to over $2.4 trillion.
Okay, here's where it gets really interesting to me because this data seems to completely defy basic financial gravity.
How so?
Well, you have everyday Americans going on this massive borrowing spree, 41% more auto loans, 46% more new credit cards. Historically, when you see a sudden, massive surge in consumer debt, you usually expect to see an accompanying surge in people struggling to pay it back.
Right. Defaults usually spike.
Exactly. But the presentation shows that total net loan charge-offs actually dropped by 10 basis points, down to 0.34%.
It is a wildly counterintuitive outcome.
And just to clarify the mechanics of a basis point for a second, a basis point is simply 1/100 of 1%, right?
Correct.
So dropping 10 basis points means the charge-off rate fell by 0.1%. A charge-off rate of 0.34% means that for every $10,000 the bank has loaned out, they are formally writing off only $34 as uncollectible.
Exactly right.
How is that functionally possible in today's economy? Consumers are loading up on high-interest debt, but the rate of people defaulting is shrinking.
So if we connect this to the bigger picture, it actually aligns perfectly with a commentary from CEO Charlie Scharf in the news release. He explicitly cited broad-based economic strength.
Okay.
Consumers aren't just borrowing money, they're actively spending it. Debit card purchase volume alone was $144.8 billion in the quarter.
Wow.
Yeah. Scharf noted that while there are undeniable concerns around housing affordability and persistent inflation, the labor market and wage growth remain remarkably strong.
The mechanism here is simple. When people have secure, well-paying jobs, they can service higher debt loads without tipping into default.
So the data suggests this isn't necessarily desperate borrowing to cover groceries. It is confident borrowing backed by reliable paychecks.
That is the macro narrative, yes. However, as an analyst, you always have to look at the plumbing of the report.
The fine print.
Exactly. There is a technical nuance buried in the presentation that we really have to discuss. The consumer loan growth looks incredibly robust, but part of that is due to an internal accounting shift.
Yeah. The report notes that in the third quarter of 2025, Wells Fargo transferred approximately $8 billion in loans and $6 billion in deposits related to certain business customers out of their commercial banking side and moved them over into the consumer banking side.
Hold on, wait. Let's look at the implications of that. If they take $8 billion in established, stable business loans and essentially dump them into the consumer bucket, doesn't that artificially inflate the consumer growth numbers?
It does.
And more importantly, doesn't that larger denominator artificially dilute the consumer default rate?
It absolutely dilutes the percentage.
Like, if I have a pool of high-risk consumer credit cards and I suddenly mix in $8 billion worth of historically reliable commercial loans, the overall percentage of defaults in that newly mixed pool is mathematically going to drop, right?
Right, because the total pool is bigger and safer.
Exactly, even if the underlying credit card users are defaulting at the exact same rate. So is this accounting shift making the American consumer look financially healthier on paper than they actually are in reality?
That is a phenomenal catch, and it is exactly why you have to read the footnotes. Yes, the denominator effect is very real here. That $8 billion transfer increases the total base of consumer loans, which mathematically suppresses the overall charge-off percentage for that division.
Interesting.
Now, the bank discloses this transparently, so it isn't nefarious. But it does mean the headline drop in consumer charge-offs is partially an optical illusion.
Created by internal restructuring rather than a pure reflection of improving credit card health.
Exactly. Now, even when you adjust for that $8 billion transfer, the underlying consumer default metrics do remain historically stable. But the technicalities definitely amplify the sunshine in the headline numbers.
Right. It makes it look a little bit rosier than it might be. Which brings us to the final and perhaps most revealing piece of the puzzle. We have a bank that is operating with ruthless efficiency. We have $1 trillion in loans, consumers actively paying their bills, and a 25% profit surge. If you are sitting in the boardroom looking at these metrics, the natural human instinct is to throw caution to the wind, right?
Oh, totally. Step on the gas.
Step on the gas, accelerate lending as fast as possible to capture market share. But when you look at their capital strategy and the leadership commentary, it tells a very different, deeply sober story.
It is a stark contrast in tone. First, let's look at the sheer amount of excess capital they are generating. They reported a ROTCE of 17.7%.
ROTCE, return on average tangible common equity.
Right.
That is essentially the ultimate test of banking efficiency. You strip away all the abstract accounting fluff, like the goodwill value of their brand name, and you look strictly at the hard physical cash and solid assets the bank holds.
Exactly, the tangible equity.
So a 17.7% ROTCE means that for every actual dollar of hard equity sitting in the vault, they are spinning off nearly 18 cents in pure profit.
It is an incredibly strong return metric. And because they are generating capital faster than they can safely deploy it into new loans, they are returning massive amounts of it to their shareholders.
Okay, how much?
The report shows they repurchased $3 billion in common stock in just the second quarter alone. That equates to 37.4 million shares bought back and retired.
And let's connect the mechanics of that stock buyback right back to the very first metric we discussed, the $2 in earnings per diluted share.
Oh, this is the best part.
Right. By taking 37.4 million shares completely off the open market and retiring them, the total corporate pie is now sliced into fewer pieces.
Yep.
This automatically makes every remaining share more valuable. It mechanically boosts that earnings per share number for the next quarter, even if their actual net income stays entirely flat.
Exactly. It's financial engineering that directly benefits the remaining shareholders. And alongside the buybacks, they are also planning an 11% dividend increase, taking it up to 50 cents per share for the third quarter.
Wow, so they are really returning a ton of cash.
They are. But to your point about the boardroom tone, this aggressive return of capital is paired with heavy warnings from the top.
Right. Despite these phenomenal metrics, CEO Charlie Scharf's commentary is almost deliberately tempering the excitement.
Yeah, he's actively cooling it down.
He explicitly warns that favorable conditions do not go on forever. He stated the bank is being highly selective about how and where it chooses to grow. His stated goal is to build a balance sheet that is capable of enduring inevitable market shocks and economic cycles.
He is definitely tapping the brakes.
I mean, if the U.S. economy is a highway, the CEO sounds like a driver who is speeding up on a straightaway, passing everyone, but he's doing it with his left foot hovering right over the brake pedal.
Just waiting for a crash up ahead.
Exactly. Why is the leadership so vocally obsessed with inevitable shocks when their own internal data points to an incredibly strong current environment with dropping defaults and rising spending?
It really comes down to institutional memory and the reality of the regulatory environment they operate in. Commercial banks are fundamentally in the business of managing risk, not just chasing reward.
Right.
When credit spreads are narrow, when consumers feel wealthy, and when equity indices are hovering near all-time highs, as Scharf pointed out in the release, that is precisely the moment a disciplined bank starts building its defenses.
You repair the roof when the sun is shining.
Exactly. And we can see exactly how thick that roof is by looking at their liquidity buffers. Their CET1 ratio sits at 10.3%.
Okay, CET1 is Common Equity Tier 1.
Yes.
That is essentially the bank's ultimate doomsday emergency fund. It measures their highest quality, most liquid capital held in reserve against all of their risky assets. So 10.3% provides a massive fortress-like buffer that's well above the strict regulatory minimums.
It does. It's a huge cushion. And they pair that with a liquidity coverage ratio, or LCR, of 119%.
Meaning they hold 19% more highly liquid cash-like assets than federal regulators mathematically require them to hold in order to survive a severe 30-day stress scenario or a bank run.
Right. They are sitting on a mountain of cash.
Literal mountain.
And that is the definition of managing a massive institution through the economic cycle, rather than just reacting to the euphoria of the current quarter. They're openly acknowledging the lingering shadows in the macroeconomy. They see the sticky inflation data. They see the housing affordability crisis, straining household budgets. They're taking their windfall profits today, rewarding their shareholders now, while intentionally barricading the doors to protect against a tomorrow they believe will be much more difficult.
So what does this all mean for you, navigating the economy today? You have just gotten a masterclass in the realities of modern corporate banking. We've explored how Wells Fargo engineered a massive 25% profit surge. And they didn't do it just by relying on traditional mortgages. They did it through a sophisticated mix of capturing high-end VIP advisory fees, executing incredibly strict headcount reductions to drive operating leverage, and servicing a consumer base that is surprisingly eager to take on debt, and at least for now, highly capable of paying it back.
It is a very detailed portrait of an economy that is still running incredibly hot, but managed by a banking sector that is actively structurally preparing for it to freeze.
And that contrast leaves us with one final lingering question for you to ponder long after this deep dive ends. If a financial titan with over $1 trillion in loans and unparalleled real-time access to the credit card spending habits of millions of Americans is actively bracing its fortress balance sheet for an inevitable market shock.
Which they clearly are.
Right. What invisible economic blind spots might they be seeing on the horizon that the current sunny default rates just aren't showing the rest of us yet?
That is the exact puzzle every major investor and economist will be trying to solve in the months ahead.
Thank you so much for joining us for this deep dive into the numbers that run our world. Keep questioning the data, keep looking for the real mechanisms beneath the headline statistics, and as always, stay curious. We'll catch you next time.